on Tuesday, we learned that similarly to the capital structure decision, the dividend policy can be also irrelevant to the value of the firm as well as the wealth of the shareholders. And it will be only possible theoretically under certain assumptions. So in reality, we have several factors that could affect the firm's dividend policy, and they include taxes, the desire for current income, the client effect, and the information content effect, those things. So there, as a result, some companies prefer a low dividend payout ratio, while other companies prefer a high dividend payout ratio. And today, we are going to talk about other forms of payouts. The first one is the stock repurchase, which is a direct and the strongest alternative to paying dividends. And then second, we are going to talk about the stock dividends, which seem to be very similar to the normal dividends we talk about. So in comparison with the stock dividends, we just call the normal dividends as cash dividends, because usually we pay cash to our shareholders, while in the stock dividends, we pay stock shares to the shareholders. So we are going to talk about that stock dividend as our last topic for this chapter. So let me begin with the stock repurchase. So what is a stock repurchase? A stock repurchase or share buyback is a company's purchase of its own shares. So the company use some money to purchase its own shares, not the shares of other companies. So in that sense, this is called as a repurchase, because actually those shares were sold by the company to the shareholders. And then now in this stock repurchase, the company is trying to buy back the shares from the investors, the shareholders, to by him. So there are several ways to do stock repurchases. One way is to have open market purchase. Open market purchase is that the company goes to the stock market as other individual investors do, and they do not reveal what they are or whom they are, and then just buy the shares in the stock market. On the other hand, we can have a tender offer, which is a public announcement that the company will have a stock repurchase. And then the company informs the information about the stock repurchase. For example, they specify the particular price of the stock they want to purchase and the number of shares they want to have. And then if you are an investor, if you are a shareholder, and if you are interested in this offer, then you can submit your form to the company, and then at the end of this tender offer period, the company will take your shares and give you the promised money. The third way is called targeted repurchase, which is buying shares from a specific people, a specific stockholders. So those are usually done for a private companies which are not listed in the stock market. Okay. And from now on, we are going to compare paying dividends and stock repurchases. So, and then finally, we are going to learn that actually paying dividends and repurchasing shares have similar effects. So there is no difference, significant difference between paying dividends and repurchasing shares from a shareholder's point of view. But however, there is a slight difference. The after that, the post-event stock price can be changed, and also earnings per share (EPS) can be changed. So there is a company, and this company is 100% equity financed for simplicity, and it has excess cash of $300,000, and therefore this company plans to pay out those cash to the shareholders to increase the wealth of the shareholders. And currently there are 100,000 shares outstanding, so the number of shares is 100,000, and the total market value of equity is $1 million. And also the net income is $49,000. And let me first see what happens if the company pays dividend. And before that, just let me check the stock price, because we have the market value of equity and we know the number of shares, and we can calculate the stock price. The market value of equity is $1 million, and the number of shares is 100,000. Therefore, each stock will worth $10 per share. And also, we can calculate earnings per share as the net income divided by the number of shares, and net income was $49,000 and the number of shares is 100,000. So the EPS, earnings per share, are $0.49. The price earnings ratio is the stock price divided by the EPS. So the stock price is 10 and the EPS is 0.49. So the price to earnings ratio, or PE ratio, is 20. Case 1. So let's say the company decides to pay dividends using the cash. So it has excess cash of $300,000. So the company can give shareholders this amount of money as dividends, and therefore, because the number of share is 100,000, for each share a shareholder will receive $3. And then, because the company has used $300,000 out of its cash, the remaining asset will become worth $700,000, and therefore the new stock price will be 700,000 divided by 100,000, so it will be 7. And comparing this result, the change in the stock price, with the previous stock price of 10, you can see that before paying dividend, it was $10 per share, and we get the dividend of $3. So therefore we have a X dividend. So we have $7 per share as the stock price. So the difference between 10 and 7 is exactly the dividend paid to the shareholder. So this is, again, this is the observation we can find from the X dividend date. So there will be a stock price reduction when a company decides to pay a dividend, because that is dropped from the share, so the right to receive the dividend is now foregone, so the stock price will be reduced. However, it does not affect the wealth of the shareholders, because if you were a shareholder before receiving the dividend, you had $10 if you had one share. However, after the company pays the dividend, your stock will worth $7. However, with also you get the cash dividend in the form of cash, so 3 plus 7 results in 10, which is the same as the value of a stock before paying dividend. Therefore, actually your wealth will not be affected. So this is related to the irrelevance of the payout policy. And the number of share is not changed and the net income is not changed, so the earnings per share will be the same as 49 cents as we have calculated before. And the price earnings ratio can be changed because now the stock price is 7, so there is a decrease in the stock price. So the price earnings ratio, or the PE ratio, is reduced from 20 to 14. So now let me think about the second case where the company repurchases some shares. First, the number of shares that the company repurchases is determined by the cash the company has and the stock price. So the company has $300,000 cash, and each share is worth $10 in the stock market before the payout. Therefore, the company can repurchase 30,000 shares in the stock market, and then after they repurchase their shares, they will cancel those shares. So those shares will be gone and the number of shares will be reduced. So before the paying out, the number of shares was 100,000. However, now the company has eliminated 30,000 shares by repurchasing. Now the number of shares outstanding will become 70,000. And at the same time, for this stock repurchase, the company has used its cash 300,000. Therefore, the new market value will become 700,000 after the stock repurchase. And the market value of the firm is same as the case number 1. Then the new stock price is the new market value divided by the new number of shares, which is 700,000 divided by 70,000. So it is $10 per share. So actually, you see that the stock price does not move when you repurchase. So previously, before the paying out, the stock price was 10, and after the repurchase, the stock price will be again $10. So there is no change in the stock price. The wealth of shareholders is therefore $10 per share. So if you are a shareholder, you are still having a share which is priced at $10 in the stock market. So regardless of the company's decision, your wealth does not change. And the earnings per share can be changed because the number of share has been changed. The net income is still $49,000. However, the number of shares is now 70,000. So the earnings per share will become 70 cents. And the price earnings ratio will be 10, because the stock price is 10 divided by 0.7, which is 14.3, and that price earnings ratio is same as the price earnings ratio in the case 1, where the company pays dividend instead of the repurchase. So if we compare two cases, we can get those results. First, the shareholder's wealth will not be affected in any case. The wealth of a shareholder is always 10, regardless of the company's decision to pay whether the dividend or the stock repurchase. Second, however, earnings per share can be changed. Earnings per share is only 0.49 if the company pays dividend. However, it will be 0.7 in case of the stock repurchase. And also, the stock price is higher in the stock repurchase. The stock price is still $10 after the repurchase. However, in the dividends, the stock price will be fall to $7. So one thing that you can be misguided is that what happens to the shares that the company repurchased. So actually, in the stock repurchase, you have two options. As a shareholder, if a company will have a stock repurchase, then as a shareholder, you have two choices. Let me assume that this will be done by a tender offer. Then the first option for you as a shareholder is to agree on the tender offer. The second thing that you can do is do nothing. Oh, actually, there's a third way. You can sell the share and stop investing in this company. And actually, those three choices will result in a single answer. Your value is always $10 per share. First, let's say you agree on the tender offer, then you will get $10 for each of the share you are having, and then the number of shares you are holding will be 0 after this tender offer. Second, if you do nothing, then you do not get the cash. However, because the stock price is still maintained at $10, you are having $10 for each share. And finally, the third choice is to sell your shares in the market. Then actually, because the stock price is also $10, you will get $10 cash for each of the share you sell. So regardless of your choice, you always result in having $10 for each of the share of the company. So the company's tender offer for the stock repurchase, actually you can participate in this tender offer or not. However, it will not affect your wealth in this case. So what we can say is that dividends and the repurchases are the same. And the basic idea is giving the cash of the company to the shareholders. However, the one difference is that in dividend paying out, you are giving cash for each shareholders directly. On the other hand, in a stock repurchase plan, you are indirectly giving the money to the shareholders, because you are buying some of the shares. However, some other shareholders who are not participating in the stock repurchase plan may feel that they didn't do nothing, so they have nothing to do, but still their values are the same. So paying dividends and repurchases are slightly different in the way that the money is given to their shareholders. However, it is just a matter of timing, so it doesn't affect the shareholders' value and as also the value of the company. And then why they are different? Because some may prefer dividends while others prefer repurchases in the reality. So the main reason the advocate for the repurchase is that repurchases are more flexible. So as we learned last time, if you start giving dividends to the shareholders, then you cannot cut dividends, because as soon as you cut your dividend, then your shareholders will feel that the company is in trouble. So you have to avoid that situation. On the other hand, for the stock repurchases, you can have stock repurchases this year, but it doesn't matter whether you continue to have stock repurchase in the next year. So it gives a more flexible options, more choices to the company's management team. Therefore, it is more favored by some of the managers. And second is that it doesn't drop the stock price. Although the dividends will result in no change in the wealth of the shareholders, because for each shareholder will have cash of $3 as dividend and $7 in the form of stock, so their wealth is still maintained as $10. So actually there is no change. However, if you are not a shareholder, then maybe you will be confused, because it seems that after paying dividends, the stock price of a company has dropped, and therefore maybe some investors does not understand this irrelevance proposition, and therefore they feel that the company is doing wrong. So they may avoid buying the shares of the company. On the other hand, in the stock repurchases, it does not affect the stock price. So the stock price will be maintained after the stock repurchase. So it is more favorable. And also, it will result in a higher EPS. So in our example, when the company pays dividends, the EPS was 0.49. However, when the company has stock repurchases, the earnings per share is 0.7. So the EPS in case of the stock repurchase is higher than the EPS in case of the dividend. And many CEOs and other chief executives are compensated by the earnings per share. So some of their working conditions, their contract between the company is made as a base salary and the bonus for their performance, and sometimes the bonus is tied to the EPS. So if they increase the earnings per share, they will get more bonus. So that's why many managers try to boost the earnings per share. And if you look at this result, stock repurchases are better way for them rather than paying dividends, although the effect is the same. Therefore, managers will prefer stock repurchases to the dividends. So, as a result of these reasons, we can see that in reality, repurchases are becoming more and more popular than the dividends. So, before 1997, the number of the value of the stock repurchases was lower, here yellow line, than the value of the total dividends. However, after 1997, now we can see that the value of the stock repurchases are higher than the value of the dividends paid to the shareholders. And one interesting thing is that actually if you look at the dividend graph, the purple line, it does not change dramatically. So you can see that, as we learned before, because of the information content effect, people and also the clientele effect, so the managers are trying to maintain their dividends, so it does not go up like this, nor it doesn't go like that. Only they are smoothing, so they are showing a more constant growth rate for the dividends. On the other hand, stock repurchases vary over time. When the performance of the companies are better, then you can see that repurchases are increasing. On the other hand, during the 2007, 8, and 9, we experienced the financial crisis, and as a result, companies stopped paying repurchases. However, at the time, still, companies that paid dividends before should have to pay dividends as they did before. So you can see that the dividends are not decreasing. However, repurchases are decreasing. So it shows that repurchases are more flexible paying out policy. And the results that you can find from the number of companies are the same. So here, before 1997, the number of companies repurchasing their shares was only this amount. However, now after 1997, now we have more companies doing stock repurchases compared to the companies paying dividends. So purple line is the dividend paying companies. So let me wrap up what we discussed so far. So first, dividends are, not all companies pay dividends. Actually, dividends are concentrated among a small number of companies, and those companies are usually large companies and they are matured companies. So if you are running a young companies or a venture companies, then you generally do not want to pay a dividend, because right now is your time to grow and to maximize your future value. However, if the company is already large and there is no room for the company to grow further, then the company starts to consider paying the dividends. And therefore, those large conglomerates, those large companies are paying dividends. On the other hand, once you start to pay dividends, and it is very, very difficult to cut your dividends. So if you managers often feel that they have to pay dividends as they have done before, and as a result, they smooth dividends. So they rarely change the amount of dividends. So the dividends are slowly growing and it doesn't go down. And finally, if there is a unexpected change in dividends, then the stock price will be affected. If you cut your dividends, then the stock price will be dropped. If you increase your dividends suddenly, then your stock price will skyrocket. So these are questions asked to the managers, and these are the survey results. So a researcher asked to the managers about their dividend policies, and they answered like this. Managers often try to avoid dividend cuts, and those managers account for 93% of all managers around the world. And they also try to maintain a smooth dividend over time. About 89% of the managers answered like that. And they consider the size of the recently paid dividends when they decide the dividend they should pay in the next year. 88%. And they try to make sure that they don't have to change the dividends later, and that the rate of dividends should be carefully managed, because if you increase the dividends, then it is very difficult to stop it at a later point of time. And they emphasize about their dividend policies. 84% of the managers emphasize being consistent. So they have to stick to their previous historical rule, and they emphasize the stability, sustainability, and also one reason why they pay dividends is to attract certain group of investors. Especially nowadays, some retired people are putting their money in the funds, and therefore those financial institutions are managing those money of the retired person. So to attract institutional investors, they are trying to have certain dividend level, and it explains the desire for the current income. And also the number 6, attracting retail investors. This is also related to the desire for the current income. And we also see that taxes are affecting their decision about the dividends, as we learned in the real world factors. Okay, so far we talked about the dividends and stock repurchases as an alternative to the cash dividend. And now we are going to learn about the stock dividends. Seemingly, this is a kind of a dividend because it includes dividends in its name. However, actually it is not a dividend. A stock dividend is a payment to the shareholders, but in the form of the stock. Please note that we call something as a dividend when the payment is in the form of cash. So the stock dividend is not precisely the dividend that we have been discussing. And there is another term called a stock split, which is making more shares out of a single share. And this stock split is increasing the number of shares outstanding without changing the value of the equity. And actually, stock dividends are closely related to the stock splits rather than the cash dividends. So they are the same. Stock dividends and stock splits are essentially, basically they are the same. So let's say there is a company named Peterson Corporate Company, and this company has 10,000 shares outstanding. And the stock price was $66 per share. And it plans to pay a 10% stock dividend. And let's see what happens to the company. So before that decision, the market value of equity can be calculated from the stock price. So the stock price was $66 per share, and the number of shares was 10,000. So the market value of equity is $660,000. And because the company gives 10% share for each of the share, the number of shares will increase by 10%. So before that stock dividend, the number of shares was 10,000. However, after the dividend, the number of shares will become 11,000 shares. And furthermore, there is no cash in or cash out of the company, so the equity value does not change. It means the stock price will be affected. This is the market value of equity before and after the stock dividend, and the new number of shares is 11,000. So the stock price will be $60 per share. So after the stock dividend, the stock price will fall. This is actually a very simple result. So you have a delusion when you make more shares, because the market value is the same. However, if the number of shares increases, then you are splitting the value to more people. So the value of each share will be dropped. So that is a very simple calculation, mathematics. Then the stock dividends and the splits actually do not affect the wealth of the shareholders, because even though there is a dilution, the number of shares you are having will increase. For example, in this example, if you had 10 shares before the stock dividends, now you are going to have 11 shares, which means before the stock dividend, you have 10 shares, each worth $66, and then your total wealth will be 10 times 66, which is 660. However, after the stock dividend, now you have a 10% increase, so the number of shares you are having will be 11. However, the value of each share will be dropped to $60. So your total wealth is 11 times 60, which is again 660. So the decision to have a stock dividends actually do not affect the value of the shareholder. this is a theoretical calculation. However, in reality, there are certain costs that are related to issuing new shares. For example, you have to use a security companies or investment banker as an underwriter, and you have to pay some fees for their underwriting services. You also need to register and file your securities to the SEC or other regulatory authorities. You also need to hire a lawyer or some auditors in order to prove that your shares are valid. That means you have to pay certain cost during this stock dividends process. It means you are wasting your money, so you are gaining nothing, so the value of the firm will be lowered. Then why companies try to have stock dividends and stock splits despite the fact that it doesn't improve the shareholders' wealth? Some of the explanations include popular trading range. So sometimes your stock price are too high or too low. For example, let's say so one of the most famous companies in South Korea is Samsung Electronics. And several years ago, the stock price of the Samsung Electronics was $1,000,000 Korean won, which is about $1 billion US. So it was too high for an individual shareholder to purchase or sell. So Samsung Electronics did stock split, and as a result of the stock split, now the stock price nowadays is about 70,000 Korean won. So it is more favorable for individual shareholders. And this is possible because during the process of the stock dividends and split, the number of shares will increase, which means the value of each share will be reduced. So that's why some companies try to have stock dividends or stock splits so that investors can fully participate in the trading of the shares. However, theoretically, this is a bad decision. This is just a decision based on the behavior of the people. So many researchers claim that companies should not have stock dividends and splits.